All right, well, welcome back, everybody. We just enjoyed a delicious meal, as you can see by all the plates on the table that are empty. We just had a delicious meal at John's Best Pizza Restaurant, and here in Brookfield. So we left off. Actually, I was about to tell you what the government noticed. They noticed that the success of the Kickstarter model allowed them to make some sweeping changes through a new law they passed called the 2012 Jobs Act. And in that law that was signed by the Congress, the Senate, and the President, they actually included provisions for small businesses to use crowdfunding to capitalize their businesses. So just to keep it really simple at first, and then I'll go into the details because I'm sure there's going to be some questions. What that provision essentially is doing is it is creating a stock market for private companies. So you have your traditional markets, which are your big IPO companies with a lot of regulation, a lot of cost to comply. Now you have Title II equity crowdfunding and Title III equity crowdfunding, which is the provisions in the Job Act that are allowing small businesses to raise capital. And they're going to actually have a secondary market for these type of small companies as well. So take your traditional Kickstarter model, instead of a donation, if a small business like a restaurant wants to actually put their project online, people can make contributions, but instead of a reward for that contribution, in other words, you're not going to get a prime rib for that contribution. Instead, you're actually buying a share of that restaurant's corporation, so they're offering you equity. Or if the restaurateur just wants a loan, you can make them a loan and earn a rate of interest on your actual loan, on your contribution. So the regulations that came out on October 23rd, which related to this law that was passed, were 585 pages long, and they're currently out for comment by the American public to read through some of them and make comments to see what the final rulings are going to be. And the end of the comment period is February 3rd. By the time all the final comments are integrated into the final rulings, we're looking at probably the first businesses doing this in April of this year. They'll start going to these different kind of websites to put their project online and raise the money. So how is this going to work? There's a lot of what ifs right now because it's still getting set up. But essentially, if you're a business, you're going to now be known as an issuer, and you're going to have to disclose a lot of different things to the Securities and Exchange Commission, the government agency who's regulating this. If you are the equity website that is essentially allowing the business to go on your website and be the intermediary to transact what's about to happen between the business and the American public who's the investor, you as that intermediary are known as a funding portal, but you will have to either be a broker-dealer, meaning you'll have to have the broker-dealer capabilities in order to essentially set up brokerage accounts for anyone who buys shares. Yeah, for anyone who buys shares in these companies and anyone who loans money to these companies. So they're regulating it, and they are creating products such as shares of stock and debt instruments. So they are creating a stock market for private companies. Now, because of the recession, right, banks are not making as much loans anyways. It's hard to get a loan if you want to be a business. But if you're a restaurant, who knows your business better than your customers? If you frequent a restaurant and you know it's a popular place and you know that the food is great and the service is great, the way that all this is going to actually work, the way that you can actually ask people to invest in your company if you're raising money through debt or equity, is only through online and only through social media. That's the only way you could generally solicit people. And so in other words, I can't pick up the phone and call Russell right now and say, Russell, I want to sell you a share of my restaurant stock. Send me a check for $20 and here's my share. Fraud. If anyone asks you to do that, that means they're fraudsters. The only way that it's going to be able to happen is they're going to send you a link to their actual website that has all the disclosure requirements. It's going to be an online prospectus. It's going to be a red herring, an online prospectus that individuals will really have to look into in order to be able to invest. And as I mentioned earlier, 1933, only accredited investors could invest in companies, meaning there was only 8.7 million Americans today who qualify as an accredited investor. They lifted that requirement and they're saying anyone regardless of income can invest in these private companies, which means now there's 300 million Americans who could potentially invest in this manner. They limit how much each individual can invest, however. So if you make under $100,000, you can only invest $2,000 a year or up to 5% of your income. If you make over $100,000, you can invest 10% a year up to a total amount of $100,000 a year. If you're a business, again, they're going to be known as issuers, like a restaurant. You have to be a corporate entity, and you can raise up to $1 million every 12 months. So it's every 12 months you're able to raise the money in that manner. And I'm seeing a few of your faces, and some of you are surprised, some of you are concerned. And there's a lot of regulation around this to protect the American public. And there's a lot of opportunity here to spur economic growth. And I'm sure the first questions are going to be, how is this going to work? How is it going to be protected, and how? Yeah,
that's my question. Protection.
So, can you show the lady asking the question, please?
Do you mind?
No, my question is,
She's not a lady.
how is this all protected?
She's Mother Superior.
So how is an investor?
If I was going to be an investor, how is all this protected with what goes on in the internet nowadays and everything else? I mean, I think to me it's kind of scary.
No, you're right. That is a legitimate question that you raise. And so the way that I see it is, the internet is a place where information is at your fingertips. So anyone who wants to raise money in this manner has to be ready for to get scrutinized. So the whole point of crowdfunding is building a crowd of people who invest their money and pool it into a certain resource. The Securities and Exchange Commission had 585 pages of regulation, and in those pages of regulation, they're specifically saying certain things that this business has to disclose. If they don't meet the requirements and the investor is not sophisticated enough to actually provide what they're asking for, they're not allowed to even put their job, or not their job, they're not allowed to put the business online in the first place. So to even be able to do this will require some level of sophistication and some level of proven track record on the individual who's posting the job in the first place. Number two, the crowd of people who now are going to look at this offering, this so-called, this prospectus, this business plan, and this term sheet, they have the ability to ask questions directly to the business owner through this portal that's going to be regulating the whole process. So in other words, there's going to be public comments posted by any person who's considering this investment. And if people are posting and this person cannot answer those questions, then essentially the crowd is self-regulating to a certain extent to say, this guy doesn't have his act together, he doesn't have a good business plan. He doesn't have the tools necessary for us to feel confident to invest. Now, at the same time, people who will succeed in this will likely be individuals who have existing businesses, but there will be startup businesses without a track record that are trying to raise money in this manner. And so this is the tricky piece of this is, if you're a startup business, how can you convince an investor to invest in you? Because that's what venture capitalists do, right? They tend to invest in a venture that they see potential in, and they believe that the individual has invested something into the business themselves. So it goes to show that there's a lot that needs to be worked out. But in that 585 pages of regulation, to me, it's going to safeguard the majority of fraudulent activities, but it's not going to do all of it. You're absolutely right. But in the current stock market, there's fraud that occurs all the time too. So if someone's going to commit fraud, right, they're going to be able to commit fraud whether it's in this platform or in the public companies, as we see in the news all the time. There's fraudulent activities.
Didn't you say that the security exchange is going to control this?
Yes.
Do the businesses that desire to do it that way, that you're speaking of, don't they have to go to the SEC first to get the okay, or to answer the questions that are required per the regulation before they even have the okay to make a submission on the internet?
Absolutely. So the Securities and Exchange Commission is regulating this process, which means because the business is not known as an issuer, they have to issue financial statements. So certain offerings over $100,000, for instance, and the final rulings are not out yet, but they're saying that if you're raising over $100,000 in this way, you will need to have audited financials. So that's another safeguard. There's audits in place. There's compliance costs that will need to be accounted for in order to get the American public comfortable, and to even have a business go on a website, it has to meet all these compliance requirements. So this is a part of the law that some people are also trying to determine is, if I only want to raise $30,000 for a business, but it costs $10,000 to comply in the first place, am I going to try to raise money for only $30,000 this way?
Mm-hmm.
Maybe, maybe not. It depends. But probably not. But if you're trying to raise more money and you're getting an auditor to certify the financial statements before the fact, then you're adding the layer of certification that the audit gives you in order to get a little bit more comfort. So will every opportunity be worth investing in? Of course not. But that's why everyone has to assess, even in their normal portfolio, when you're trying to invest in any company or any opportunity, is it worth your investment?
Okay, so you would be the investing portal or the funding portal?
No, RealityCrowdTV is actually a reality television program that I'm creating about the movement of crowdfunding. And we are actually going to crowdfund our own TV show through the Kickstarter model, the donation-based approach. And we're going to be offering rewards to incentivize people to help us create this program. Yes, Robert?
What question I have is, does the system itself or the SEC have any safeguards in place to protect against fraud? Like when you mentioned, people could ask questions of the issuers. What if the issuer lies? I mean, are there any safeguards in place to verify the information that's protected, that's provided? Are there any third-party overseers of the process? It's almost like in the old days when the internet had these chat rooms, there was somebody that monitored it to make sure there wasn't any illegal activity. Is there anything like that in place? So if somebody misrepresents something to entice an investor, is there a way to catch that?
And the answer to that is, initially, it could be done through the actual audits that need to be certified, so those people could help in that regard. Mm-hmm. The other side of the equation is the funding portals and the broker-dealer aspect of things. They have to actually register with FINRA, which is the Financial Industry Regulatory Association. So the broker-dealer side of the equation is FINRA. The actual businesses that are raising money this way is the Securities and Exchange Commission. So the funding portals or the broker-dealers who are allowing these individuals to post their businesses on their websites have a duty to do due diligence on them as well.
So I'm buying through a broker-dealer then?
Excuse me?
So I'm not buying directly, I'm buying through a broker-dealer, there's that layer I'm going through?
You're not buying directly from the business owner.
Okay.
You are buying directly through an exchange, essentially.
Okay.
As I mentioned, it's like a stock market for private companies.
Okay.
You have to go through a broker-dealer who is transacting the transaction on behalf of the investor. So the investor goes to the website, which is a broker-dealer.
Right.
They purchase the stock, they like what they see, they like the business, they purchase the stock, or they loan the business money. And now the broker-dealer on the back end has a custodial account to hold those securities that were just transacted. And so there is that level of onus on the funding portal that they're going to have liability if they don't do due diligence either. They can't just put anybody on the website. They have to actually ensure that this person who wants to actually raise money for their business is actually complying with the regulations, is actually a legit organization. The business owner has to go through background checks. They can't be a bad actor, as is known. If they have a criminal history, they won't be able to do this. And what's amazing is, Google is a powerful tool. You Google someone's name, you quickly see if they have some issues right away. So that's what I mean by the actual power of the internet and more information at the fingertips. So the reason why this is, the concerns are extremely valid, and all these have to be worked out. But let's try to look at the positive side of this. Let's say again, you know a restaurant, and you know that they do well, and you know the food is great. But for whatever reason, they got declined by a bank, because the bank's criteria is black and white. And you also know that they don't have an individual who's wealthy that they can go to in order to fund the expansion that they're planning. At that point, that individual essentially says, I can't open, I give up, I can't do it, I gotta delay it for what, 5-10 more years until I save the money. Now, individuals who know this person personally, individuals who know the business, they go to it every week, can now help spur economic growth, especially if the business is complying with all the regulations and is going through this. They can help spur economic growth by investing in their neighborhood businesses. They can help their neighborhoods create jobs by expanding businesses. They can create economic activity in ways that currently is not available because there are restrictions on lending right now. The economic growth in America is a little bit stagnant, and everyone knows it. I mean, it's getting better slowly, which is good. So slow but steady is good. We don't want to go overdrive like it was previously. But if there's an opportunity to help somebody with an established business, or if there's an opportunity to help someone with a proven track record who wants to start a business to create economic activity, and there's no fraud involved, it offers that individual the opportunity to create jobs and provide a positive societal impact. And so the issues that are raised today are very important because we need to work those out. Not we or me. I don't consider myself an expert, but the people who are working through this, the regulators, when they finalize all the rules, they'll have the clear-cut guidelines that will say this is how it's going to work in the future. And Russell, you've been quiet. I'd like you to ask me a question.
Well, how would you distinguish your business idea from a penny stock dealer?
And when you say you, do you mean me, or do you mean anyone who's trying to raise?
Business, you know, what you basically described is penny stock. You know, penny stocks are stocks that aren't, they're not traded on the New York Stock Exchange or one of the major exchanges. You have to go through a broker dealer, and you know these are generally not very liquid, but you know, it's a way that a small business can potentially raise money. They're classically bad investments, but some of them turn out. You know, anyway, basically what you've described is using the internet to publicize